the avoidance of doubt, the simple side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another weekend send out from the simple side. Today is just a quick newsletter. I didn't really have time to get in depth on a bunch of things, but I just want to look at some interesting trends that I'm seeing in the S&P 500, and we'll talk about it all right now.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, like I said, it's going to be a quick one. I'm probably going to talk more about the stocks at the very bottom of this newsletter than I am going to talk about all of the different charts that we threw up there for you. But in general, it's pretty simple what we're sitting here looking at and talking about with the S&P 500. We're just talking about that year to date, the stock market has risen nearly 8%. And I really didn't think that that number was going to be plausible, at least this early in the year. The S&P, well, I guess the SPY has averaged an 8.65% compounded annual growth rate with relatively few major drawbacks. And of course, you can see a bunch of graphs in here that show that, and I've graphed it along with the compounded annual growth rate over time. And it should come as no surprise that since 2023, the compounded annual growth rate in the stock market has eclipsed 17%, running all the way up to 17.85%. And that's assuming that we have positive returns through the end of 2026. But really the point is that over the past couple of years, we have just had an insane growth rate in the U.S. stock market. And we've also been having great years. And I just wanted to point out that we've only seen 3 years of straight gains, only 3 times. So 3 years of straight gains, only 3 times. All right, so what does that mean? Well, in 1995 through 1999, we had 5 years of positive returns in a row in the market. Another time we had that was 2003 to 2007, another 5-year run. And now is the only other time that we've gone over 4 years in a row, assuming 2026 ends up positive. And that would be from 2023 to 2026. Now, I'm sure that I don't need to remind you what has happened in the years following those first 2 runs, ending in 2000 and 2008. And of course, you can't just look at a trend and immediately apply it to history every single time. But it is interesting to look at that and then also see that the compounded annual growth rate in the past couple of years has been much higher than it has been relative to what's average for the market. And I do believe that all things do return back to their average. But one thing I do want to highlight in that same vein is the fact that during the dot-com bubble, the average returns from 1995 to 1999 were about 26%. So on average per year, 26% returns. Now, in the 2023 to 2026 run, we're only averaging 18% returns. Now, of course, this could go up as 2026 starts to perform better, outperform, whatever you want to call it. But in general, it's not looking super awful. We're still pretty far below what we saw during the dot-com bubble. And of course, we don't want to see what we saw during the dot-com bubble, which was 3 straight years of a declining stock market. But in general, we should be relatively fine for now. One of the issues that we had during the dot-com bubble was that there weren't a lot of earnings to kind of show the stock market should be rising, especially in all those dot-com companies. However, in the AI world, there are a lot of earnings that can be attributed to AI. A lot of companies growing because of AI, a lot of revenue being generated from AI companies. And so we're seeing earnings actually rise in 2026. And of course, if we go and we look at the graph here, we can see SPY growth versus the average S&P 500 earnings growth. And we can kind of see, like, in general, there's a trend where when you have higher earnings growth, you have higher growth in the S&P 500. And that really shouldn't come as a surprise to anybody. I think that's pretty well known. And I put a couple of graphs into the newsletter here to show that. So we've got the SPY growth, we've got the earnings growth, and then you can see how in every single year since 1993, you can kind of see how when earnings growth spikes way up, the growth in the S&P 500 kind of spikes along with it. And a lot of times those spikes come after big drawbacks in earnings growth. However, majority of the time when earnings growth is positive, S&P 500 is positive. When earnings growth is negative, S&P 500 returns are negative. So point is, as of 2026, earnings growth seems to be very positive, which should correlate to a positive growth in the S&P 500. However, I do want to point out that the market doesn't go up and to the right for infinity, and there's always got to be a reason for the market's value to increase. And we're starting to kind of approach levels of growth historically that have pointed to declines following. So we'll have to see what everything looks like there. And it's not something I think we need to be ringing the warning bells from the top, screaming, get out, get out, get out. But it means that you do need to be paying more attention to your investments, what you're investing in, than normal. Now, real quick, I'm just going to talk about some of the paid bets. I'm just going to do this for free this time. So if you're listening to a free podcast somewhere, you'll be able to listen to the bets that I have right now real quick. If you're a paid subscriber, you can listen to this, or you can go and read it in the newsletter and see all these bets. And of course, all of these are always available on our website, which you can find at thesimpleside.news. So you can go over there and check that out too. All right, let's look at some of these holdings. One of our first bets is on RE/MAX Holdings, which of course is a play based almost entirely on the acquisition that's being made / the merger that's being made between them and Real Holdings. The price for that acquisition is $13.80 a share, and I'm taking a look at our RE/MAX. They're sitting at about $10.38, which means there's about a 32.9% potential arbitrage return that you could make on that merger, on that deal. It's expected to close in the second half of 2026. So that's what we're buying there, potential arbitrage. And it seems like these real estate deals really don't get blocked legislatively. There was a bigger deal that I mentioned when I first talked about RE/MAX that didn't get blocked. It created some insane number, like 340,000 real estate agents in one company. Of course, the RE/MAX deal is going to create like 120,000 agents, so much less, or 180,000, something along those lines. Much less, and there just doesn't really seem to be a reason to block these two companies from merging, at least in my opinion, and historically it looks good. Crescent Energy is one of the bets that we made during the oil craze. We're still up 1.4% on that bet. We closed the other bet, which was CVE, and I'm going to keep holding this. But if you don't like the oil plays anymore, just sell out of this, take your very small return, and I think you could be happy with that. The next one I've got on the list here is Oracle. Now, I sent this one out kind of one-off, but I made a note that I would be adding it to our list of research stocks because I thought it was a great opportunity. Basically, what we saw was Oracle had become oversold, basically based on like negative AI worries from OpenAI partnerships not going through, and other things relatively similar. There's not going to be enough demand. they're spending too much money. They've leveraged themselves to be able to accomplish all this stuff. So the company was oversold on, I guess AI fears, and then nothing in the company has changed other than they've grown and gotten better. And so after the sell-off, I figured that was about overdone. Figured they had some room to run back up to what they should have been at based on historical growth rates. And we're seeing some very impressive returns there. The PURR by Hyperliquid Strategies has been a great one. We're up 25% on that. I see another potential 11% going up to 750. Basically, what you're looking at here is kind of the same thing. It's a bit of an arbitrage. They own a bunch of hyperliquid crypto on their books, and it's basically created a super undervalued asset in PUR, where their assets vastly outweigh their market cap. And so what we're seeing there is basically an arbitrage play on them and their crypto holdings. Put simply, there's a lot more detail that goes into it, but in general, that's that. Now, Prairie Operating Company is one that I'm just so beaten up about. Our initial investment happened at $1.81. Since then, the stock has decreased drastically in value. It's down almost 50% from the time that we bought it. And my target at the time was $2.72, which I believe is fair, but I think the stock price is worth even more than that. And I just cannot understand why the stock has been running down in value like it has. Now, I think there's supposed to be a annual meeting or a quarterly meeting or something of that nature coming up here on the 14th or 15th of this month. And I will be paying attention to that very closely to see if the stock kind of reverses. However, I did decrease my position here by about 75%. So what I'm sitting at now is a value in the stock where if the stock does return to values that I expect it to, it'll cover those losses that I sold out on and potentially give a little bit of profit as well. But I'm just blown away by the stock value here. I don't understand why it's decreased so much. It's frustrating. But it now makes up about 2% of the portfolio. And so if we end up losing that 2%, it's not the end of the world. But if it does return like we're expecting, we could make 10% to the portfolio in some cases. Of course, we have Stride, which has been on our, I guess, picked stocks for a while now. It's one of the oldest ones that we have. It's up only 2.4%. Our target is 30% returns. I should probably go and take a peek at Stride and see why it's underperforming like it is. It doesn't make much sense to me. The company had a one-time sell-off based on legal fears, and I think it was vastly oversold. It seemed like the market was agreeing with me for a while. The stock at one point was up something like 20%, and now we're back down. So I should probably go take a peek at what is happening there, but I still like that company. I do not understand at all why their stock doesn't seem to want to grow. I know they did have bad earnings. I don't even think they were bad. I think it was just slower growth than what was expected, but overall, I think the company's undervalued regardless of current growth. And the last one we have on here has been on here since November. It's the oldest one that we have. We're up 13.7% on Next Era Energy. We're about 6.3% away from our target return. I still like it, still holding it, still think we've got another 6.3% to go up to that $99 target. So gonna keep holding on that. And then down at the very, very bottom of the newsletter, I dropped just a couple of names worth taking a peek at. Commerce.com is something that I'm looking at, down 97% all time. Valuation, of course, crushed based on AI fears. However, over the same period of time that it's gone down 97%, the company's gone from negative 36 million in EBITDA to 6 million in EBITDA. And of course, cash and debt have been decreasing. There is a bit of share issuance going on, a little bit of dilution, and there's not great asset growth, but the company's running 80% gross margins, trading at 1x sales, which is just incredibly cheap for a SaaS e-commerce platform. Of course, I think this is similar to Prop. It's a risky play, 3x opportunity over the next 3 to 5 years based on just quick math. and potential 50% returns just within the year if the valuation starts to get realized by investors. But Lord only knows if that'll happen. Again, small position if you end up taking a position in this stock. I also like Novo Nordisk right now, ticker NVO. Great trend in the stock, recovering from lows. Again, kind of sold off on bad, quote unquote, bad news for a while. Growth in GLP-1s is great, presents a great growing undervalued company in my opinion, and I think outperforming gains through the end of the year are likely. And then last but not least, we've got Airbnb, which just looks extremely promising right now. The company has an incredible ROIC to WACC ratio, buying back shares, and is basically a monopoly on non-hotel travel or non-hotel stays, I guess. Cash just surpassed $10 billion. And I really see nothing else for them to do with this cash other than buy back shares and increase shareholder value. So, the stock basically seems untouched over the past 5 years, down something like 3.57%. But it seems like a potential great value play. Of course, I'll get into a bit of this more later on. I'll talk more deeply on some of these stock picks, talk more about the valuations that I'm looking at, what I'm seeing. But in general, I think all those have the potential for outperformance over the next few months through the end of the year at least. And I will be seeing you all a bit sometime this week with some cool valuation targets and metrics on some of these research stocks. We'll see you then.